Hey everyone, just give me a second while I get the live stream started. I have no idea what I'm doing, so bear with me for a second. Hey everyone, welcome back to episode 5 of Money Monday. Uh, Today we are going to be talking about charitable planning, charitable giving, and how that works. My name is Kyle Thompson. I am the founder of Lee Town Advisors, which is a wealth management and business advisory firm. I apologize if you tuned in the live stream a few minutes ago. I accidentally started early, and basically it was just 2 minutes of me eating chips. So hopefully this sucks a little less. So let's just go ahead and get started. I'm going to share my screen so you can see what I'm doing. All right. Like I said, today we're going to be talking about charitable giving. Today we're going to address 6 different questions. Number 1 is, how much can I afford to give? Because that's a really important yet also really complicated question. It's more complicated than it appears on the surface. Question number 2 is, what options are available to business owners for charitable giving? And one of the most important questions is, what tax breaks do I get? Then the last 3 is going to be really specific to different kinds of charitable giving, specifically what are donor advised funds, what are qualified charitable distributions, and what are charitable remainder trusts. Those are especially important for people that are giving in really significant amounts. And we're going to go over all those. I'm going to try to get all this done in a half an hour, but we'll see. All right, let's get started. So, how much can I afford to give? Let's start with the purpose of money in the first place. So, the entire purpose of money is to either spend it or give it away. Either now or later, spend it on yourself, give it to others, give it to charity. But that's the entire purpose of money. A lot of people like to be really abstract about this, but that's honestly the only purpose is you make money so you can spend it on yourself, you can give it to family, or you can give it to charity. The act of saving or investing is the choice to spend less now so that you can fund future spending or giving goals, whether that spending goal is retirement, whether it's buying a house. You may have other giving goals, like you want to give money to your kids, either through your lifetime to fund their college education, their home purchase, help them through tough times, or you may want to give to charity. You can plan to give to charity over the course of your lifetime or after you pass. And those are there's a lot of complicated factors that go into that are really specific to your situation. So today I'm just going to be talking about general rules of thumb here. And again, a general rule of thumb that I have is you should be saving 20% of your income. If you're saving 20% of your income, especially if you're still young, you're going to be fine in retirement. If you save 20%, that's 20% of your gross income. So if you make $100,000, you should be saving 20. However, I do have some clients that are habitual savers. They're compulsive savers. So I have to try to talk them down to 20%. If you're saving more than 20%, you got to have a specific goal for it. And giving is a specific goal. So if you're saving 20% of your income, you should be spending or giving the rest. If you're older and you don't have much in savings yet, then you may need to save more than 20%. And giving may not be a big part of your plan right now. Otherwise, you'll have to work way longer than you think you might to be able to retire, and that's not ideal. But most importantly, it's important to be smart about giving. So, what does that look like? Being smart about giving is knowing how your giving affects your tax situation and your personal financial situation, and doesn't put you out on your own liabilities. So it's important to be able to give to your kids, to charity, to family, but don't put yourself out. If it hurts you in any way, then that's not smart. Let's start with what options are available to business owners, because business owners have more complicated situations. But we're going to start with direct giving. So business owners can't deduct any contributions to charity directly through the business, because there's no such thing as a charitable business deduction, because all that passes through your personal income and it doesn't count. However, one workaround for this is what is commonly known as sponsorships. So things like your local Chamber of Commerce, Make-A-Wish, lots of different charities have sponsorships available to you that you can deduct as a marketing expense. But that marketing expense, to qualify as a marketing expense, it has to benefit the business itself. So it has to include your logo in the branding. You may be speaking at an event that you're sponsoring, things like that. So in that case, you can deduct the entirety of it as a marketing expense. You can't just give $10,000 to charity and deduct it through the business. You have to give and then gain some sort of benefit as well. So they may include some of your branding on their promotional items, things like that. That's the way to do it if you're a business owner. Now, the most important question: what tax breaks do I get? So you don't get a tax break at all, with one exception, which I'll get to in a second. So you don't get a deduction unless you get above the standard deduction, which is, for individuals, it's a little over 12,000. For married couples, it's a little over 24,000. Now, what is the standard deduction? That is what you get. The standard deduction is available to you as part of your tax return, and it's just automatically deducted from your taxes. So to get above that, you need to have itemized deductions in excess of that standard. Now, the things that are included in that are state and local taxes, such as what you pay to the state, what you pay in property taxes. Those are the big two there. There is currently a $10,000 cap on that for state and local tax, but with current legislation, that may be raised to $80,000, which would be a big boost to high income people and people that live in high cost of living areas. There's also mortgage interest deduction, and layered on top of that is charitable giving. So there are cases where, especially in low to moderate giving scenarios, where you may be giving and not getting any deduction whatsoever. Now, the exception to that, and this is a really minor exception, but it's something for everyone to be aware of, especially people that give small amounts. As part of the Secure Act in 2019, there was a provision to allow for an above the line deduction, meaning totally separate from the standard deduction, a separate deduction for either $300 for an individual or $600 for a married couple. So someone can give to a charity or a qualified foundation up to that amount and deduct it from their taxes without having to go over that standard deduction. Now, what kinds of things are available to give to charity? You can donate cash, you can donate appreciated stocks or other securities, you can donate real estate and other properties. There's a lot of things that, as long as they have a fair market value, you can donate. But there's limits to donations. So in any one given year, and this is an oversimplification because I don't have enough time to go through this and this isn't the point. There are charitable limitations, so you can only deduct up to 50% of your adjusted gross income for cash donations and up to 30% of your adjusted gross income for capital gain property. However, if you donate in excess of that, you can carry that forward for up to 5 years. So if you donate $100,000 to charity and your adjusted gross income for the year is only $100,000, you can only deduct $50,000 this year if it's in cash, or $30,000 if it's in capital gain property like stocks or real estate. But then that carries over to the future so that you can continue to carry that deduction over to future years. So you're not just losing it, but it is only a 5-year carry forward. So you have to be strategic about how you give. And speaking of being strategic, there's a strategy called bunching. And we're going to go over first what bunching does not, what things look like without bunching. So in this scenario, you have someone that is donating $10,000 a year. They have $6,000 a year in mortgage interest and $7,000 in state and property taxes. Well, that gets them, this is a married couple. That only gets them to $13,000, plus the $10,000 of giving only gets them to $23,000, which does not get them over the standard deduction limit. So they do not get any deduction whatsoever for their charitable giving, which means no tax break. And if you don't get a tax break, it's less efficient, because when you are as efficient as possible on the tax side, it's not just to minimize taxes, it's also to make the giving more efficient, because the more efficient the giving is, the more you can give over time. So if we bunch those deductions instead, or bunch those contributions instead, and instead of doing $10,000 a year, we do $50,000 every 5 years, they're able to get almost a $40,000 deduction in year 1, which can carry over to future years, and then they do it again in year 6. Now, if you're someone that likes to contribute every year, especially if you're contributing to your church or a specific charity, this may not seem as ideal, especially because you're giving in 1 year, then nothing for 4 years. And then again, that the charity that you're benefiting, that they may be reliant on those regular cash flows, in which case you can use a donor advised fund. And what a donor advised fund is it allows for current contribution and deduction for future donation. So in this case here, you can contribute $50,000 on day 1 and get the deduction for it, but then the charity benefits $10,000 a year for each of these. So you can distribute it however you want, whenever you want, but you get the deduction in the current year. You don't have to choose the beneficiary of that donor advised fund when you do it. It can be done whenever. These donor advised funds can also grow, they can hold investments, so they can grow tax-free after you give. So in this case, they contribute $50,000, they may be $50,000 of stocks, but by the time that 5 years is up, they may actually give out $70,000 or whatever the growth is there. So that's a big advantage of a donor advised fund. So this is kind of how that works. And I totally stole this graphic off the internet because I didn't want to make it myself. So you essentially donate into the donor advised fund. It can grow over time and you can distribute to whoever you want, as long as they are a qualified charity or foundation. And in this case, it looks like it's some sort of hospital. Another option is qualified charitable distributions. Now, what this is a donation directly from your IRA. And I believe you can do it from 401ks as well, but it has to be pre-tax. Otherwise, you don't get any benefit. So if you do it from a Roth, you don't get any benefit whatsoever. So this is why I make sure clients they do have pre-tax accounts, not just Roth accounts. But you have to donate directly from the IRA. The check has to be made out to the charity, not to you. It cannot come to you at all. The check can come to you and then you forward it on, but it has to be made out to the charity. Another limitation is that you have to be at least 70 and a half years old. So you have to be in retirement already. Hopefully you're retired at this point, or at least you can afford to be retired, but are still working. And this is actually a great option for people that are high income and have a lot of pre-tax money. It'll allow them to satisfy the required minimum distributions without getting taxed on it. So this is a really, really tax efficient way to give and manage those accounts. The other limitation is that you can only do $100,000 a year. I do think this limit is going to go up at some point, but it is what it is. This is a great option for bunching your donations. This is an incredibly efficient way to do this. So here's what it looks like. So normally in a taxable situation, the IRA money comes directly to you and then you donate to charity, but you only get a partial deduction for that. You only get partial credit. In a qualified charitable distribution, none of it comes to you. It goes all directly to the charity itself, and none of it is taxable to you. And again, I stole this directly from the internet. It's some sort of elephant charity. So if you really like elephants, there is a charity out there that you can donate to that will benefit elephants. Cool, right? Okay, all right, let's move on. The last major thing is a charitable remainder trust. This is kind of similar to a donor advised fund in that it provides a current tax deduction for the donor, but instead of you controlling instead of getting distributed over your lifetime, the beneficiaries receive the money when you die. So this is particularly important for older clients, especially with significant wealth. And you do have to choose, when you set up the trust, you do have to choose the beneficiaries. But that can change over time. You can change that at any time. Also, the big difference between a charitable remainder trust and a donor advised fund is that it provides current income for the donor, meaning that let's say you donate $1 million into the charitable remainder trust. You can get income from that, but it must be at least 5% of the balance of the trust. So let's say you're 70 years old, 60 years old, I don't know, retirement-ish age. You can donate $1 million and that money will grow until you die and will be excluded from your taxable estate, meaning there will be no estate taxes on it, and it'll go to the causes that you care about when you die, and you will get income for that. But it has to be, you can't just be like, I only want X amount, I only want like 1% of it. You can't just be like, donate $100 or $1 million and get $1,000 a year. It has to be at least 5% of the balance a year. So If you donate $1 million, you would get at least $50,000 of income. The tax consequences of that are very, very complicated, and you have to be very aware of that and work with a professional to manage that. But it can also be extremely tax efficient if you do it right, especially if you take a highly appreciated asset. So like, let's say you bought Tesla right when it IPO'd and you had a ton of money in it then, and you would be facing enormous capital gains now. You can donate that stock to the charitable remainder trust and gain income from that without a large taxable consequence, as long as you take at least 5% of the balance. And again, it removes the assets from your taxable estate if you are in danger of that. So if you're single and your estate is over $11 million, or if you're married and it's over 22 million, this is going to be an incredibly important vehicle for you if you are at that level. It provides tax deferral, rather than tax avoidance. It distributes the assets over time rather than taking a huge tax hit in 1 year, which makes things much better for you. The only downside to this is that it has a really complicated structure and tax implications, and they are relatively expensive to set up. So this isn't something for small giving. This is something for really significant asset levels. So this is how it works. Basically, you yourself are the grantor. You transfer your assets into a charitable remainder trust, and you get payments back to yourself. When you die, the money, whatever money is left over, goes to charity, and you take in the income, and the tax on this, the remainder trust distributions, obviously goes to the IRS, but you get a reduction for whatever the contributions were. Again, this is a very complicated process and structure, but it works very, very well. This is what very wealthy people use to give to charity rather than direct gifts. That is it for today. I appreciate anyone that showed up today. Oh, looks like we had several people show up today. I appreciate you showing up. If you want to learn more, my contact information is, I totally left out my email. Good job, Kyle. So my contact info is kylet@leetownadvisors.com. You can go to my website, leetownadvisors.com, or schedule a meeting with me at calendly.com/leetownadvisors, and we can set up a time to talk about all this stuff. Thanks again for showing up today. I really appreciate it. And everyone have a great day.